So a very, very small amount of money coming out of the technology sector and into mining stocks of any kind can push it higher. And I think that's a trend which has now started. I think it's a trend which is going to continue. But more importantly, is it a good trend? And the answer to that is yes, because despite the rise, you'll find that many of these mining stocks are still on very low price earnings ratios. In many cases, you can find them at price earnings ratios below 10 when you've got a mainstream market trading above 20 times. And if you take the tech sector, talking about 35 times.
You're watching CapitalCosm. My name is Danny. It is September 4th, 2025. And today we've got a special episode for you guys. We've got something really cool cooked up for you. Our guest today is Clive Thompson, a recurring guest, but we've got some lesson plans for you today. We're going to talk about gold and silver and mining companies and how to evaluate mining companies. There's a ton of mining companies out there, but stock picking is essential in this case. And Clive is going to give us an overview of some of the best practices to employ when evaluating these gold and silver mining companies. So, Clive, thank you so much for coming on, my friend. How you been?
Well, thank you, Daddy, and thank you for having me on your show. What a lovely write-up you just gave me just there. Thank you very much. And hello to all your viewers.
Yeah, and quick reminder, guys, be sure to check out and follow Clive's YouTube channel. We will have that linked down below. It's currently blowing up, so you don't want to miss out on any of his videos. And yeah, let's just dive right in here, Clive. So many things going on in the precious metals bull market. Are we seeing a breakout now? Is this breakout real or not? Is this one where we see another leg up higher? What's your overview of the precious metal space right now?
Well, we just saw gold a few days ago hit an all-time high above $3,500 an ounce. And we also saw silver hit a multi-year high, about 15-year high of $31 an ounce. And they're both trading, I think, a little bit above that now. I'm just looking here. Your gold's at $3,553 as we speak, and silver's at $40.74. So those are, a lot of people are watching on the silver, the $39 level and the $4,450 level, or $4,400. We've gone through those. We've broken out very nicely. It's not going to be a straight line. It never is, because when something starts hitting a new high, it takes a few days, a few weeks, and sort of the message gets out to other people, oh, my gold, or is it a high price? And then there will be sellers come in, whilst as it breaks out, there's a lot of buyers saying, hey, it's broken up. They rush in and push the price higher. So those who expecting a sort of straight line up on silver to $50 and a straight line up on gold to $5,000, it's not going to be straight line. You will have your bad days and maybe even a bad week or two. But I think that's the direction of travel. We are going to go higher, and I think we're going to go higher for as far out as the eye can see, for all the reasons we've discussed, specifically excessive government debt, and that's on the gold side, and specifically on the silver side, the supply and demand situation, plus the fact that the US government has only just on August the 25th announced that they're going to call silver for the first time a strategic mineral, and that means they will have to rebuild their stockpiles. Last time they had a stockpile of silver, it was 2.1 billion ounces. That was back in the 1950s through to the 1970s, and they'd sold it off all by the 1980s. Now, 2.1 billion would be about 2.5 or 3 years mining supply, so they can't get there except with many, many years of stockpiling. But if they're in a consultation period on that at the moment until the 25th of September, assuming silver stays as a strategic mineral, and I think it will, because it's needed for the US electronics industry. It's also needed for the defense industry, and their major source of silver comes from Mexico, with whom they're, let's say, having a little of a tariffs spat at the moment. So they need to be sure that the supply can keep coming, and if it doesn't, they need to be sure they have a stockpile just in case. So I think they will build a stockpile. We don't know how much or how or when they'll start or anything else like that. But if this consultation process goes through smoothly on the 25th of September, they could start buying at any point after that. I think the market is seeing that and anticipating it. Meanwhile, we know for a fact on silver that the demand for silver is less than the mined supply, with the difference being met from recycled silver. Now, one of the things which actually I found quite interesting in the silver issues forecast of demand was the 200 million ounces they say will be bought by the public. Now, if you divide that by the population of the planet, you find that there's only 1 ounce for every 45 people on the planet. So I don't know about your listeners, but if anyone wants to get more than their fair share, they need to buy more than 1/45 of an ounce of silver. So if they're buying 1 ounce of silver, they're well ahead of the curve. And if they're buying 10 ounces or 100 ounces or 1,000 ounces, they're streets ahead. But basically, based on what they're thinking we will buy as investors, it's not much. And that's part of the so-called demand, which is going into this equation. So, I think gold and silver are going to head higher over the coming, I'm going to say coming years. I mean, in all probability, coming months. But as I said, it won't be a straight line. It's going to be a bumpy ride, as it always is.
And the other metal that they're adding onto this critical minerals list is none other than platinum. So what do you anticipate with platinum? Is platinum in on the ride, or is it something different?
I did a study of platinum. It was several months back, and I think I'm pretty sure I published it on LinkedIn, not on YouTube. The conclusion was that there's a real shortage of platinum, and the supply of platinum is way above ground, is way lower than the supply of silver above ground. And based on current usage, it looks like because the usage exceeds the mined supply, it looks like the entire supply of platinum will be gone in about a year and a half. So something has to happen. The price has to go up a lot to force out recycling, or I don't know where it's going to come from. But yes, I'm bullish on platinum. And when I did this study and published it, I also personally bought some platinum. I bought an ETF which holds platinum. And more recently, I bought into a platinum miner. It was only a few weeks ago, called Valterra. It used to be called Anglo-American Platinum. So I decided to buy that just to participate in the wave which I see coming.
Understood. So let's go ahead and segue over to the mining stocks. And we've been seeing these mining stocks rally pretty hard over the course of the last year or so. Have they gotten a little outstretched, though? Have they run up too far too fast? Or do you still see some pretty good upside on the part of the mining stocks?
Well, on a day-by-day basis, probably yes. But I'm talking day-by-day basis in terms of the slight overreaction we've seen in the last week, where a lot of people have said, oh my God, look what's happening to the dollar. I don't understand. We can't trust what's going to happen tomorrow. And they've rushed into gold as the gold went through all-time high, and they rushed into silver. But along with that, a lot of people said, well, gold's rising, I'll buy the gold mining stocks. So as gold went up maybe 2 or 3 or 4%, the gold mining stocks went up 10 or 15 or 20% sometimes. So there was a bit of a rush. And after every rush into something, you always have these sellers will appear a few days later and take it back. And that's what's happening today. So if you look at the gold mining stocks today, and I look at it by judging the GDX, that's the exchange traded fund, which holds the main gold mining stocks. That's down, GDX is down 1.2%, was down 2% earlier. It's down 1.2% today. So they're coming off their highs on a intraday basis. But I don't think the rally in mining stocks have gone away. And the reason for that is that the mining stocks were extremely cheap. We've had 15 years where the mining stocks have done nothing but go down until the last 12 months or 18 months ago. And then when gold started creeping up, the mining stocks basically ignored it and said, it's not real. And they just stayed where they are. And I think the reason for that was a lot of people had their mining stocks in their Robinhood account or their brokerage account. And they just thought, well, gold's going up, mining stocks aren't, they would sell their mining stocks to buy Nvidia or Microsoft or Apple or Amazon or one of the FANGs because they wanted to buy what's moving. So I think that pressure was on, but suddenly we've seen, certainly since the start of August, this last month, we've seen that the mining stocks are now outperforming the gold price for the first time in a very long time. So they're outperforming gold, and they're also outperforming Bitcoin, and they're outperforming NASDAQ, and they're outperforming the Dow Jones, and they're outperforming the S&P 500. So suddenly there's a little bit of a tension coming around to, maybe I should have some gold, and why not some gold miners? Because come the end of the year, my family, or if I'm an investment manager, my clients will be asking me, did I spot that one? And I better get it in now while I still can. So I've got some time to make money before the end of the year. So I think there's this slight move, and it's only a small amount of money going to the gold mining sector, because the gold mining sector is a very small sector. It's about $600 billion big, $700 billion big now, probably after the rise we've seen, but it's not that big compared with, say, a large NASDAQ company like Nvidia or Microsoft or Amazon or Tesla. All these companies are worth many, many billions, many, many multiples of what the entire gold sector is worth. And the silver sector is much smaller. It's worth about 200 or 300 billion. So it's tiny. And there's a lot of overlap there. If I call this gold and silver stocks sectors, there's stocks in both sectors because they are gold and silver miners at the same time. So I would say the total precious metal mining sector is probably no bigger than $850 billion compared with a large cap stock, which is in the billions, trillions. So Apple is sort of 4 trillion and so forth. So a very, very small amount of money coming out of the technology sector and into mining stocks of any kind can push it higher. And I think that's a trend which has now started. I think it's a trend which is going to continue. But more importantly, is it a good trend? And the answer to that is yes, because despite the rise, you'll find that many of these mining stocks are still on very low price earnings ratios. In many cases, you can find them at price earnings ratios below 10 when you've got a mainstream market trading above 20 times. And if you take the tech sector, talking about 35 times. So they're very, very cheap today. But what's interesting, the earnings per share of these companies will all be much higher next year and the year after than they are this year. So when I talk about price earnings ratio of 10 times, it's based on the 2024, 2025 earnings. But those earnings were based on an average gold price or an average silver price less than the price we have today. Because after all, the price is at the highest level for decades, if not forever, in the gold's case. So it's only a question of time before they have more results and they have record results. And we're seeing that as companies bring out their quarterly results. Many of them have brought out their results to the 30th of June now and reported, and they're all coming in more or less. I mean, as good as makes no difference. They're all coming in with record earnings per share, sometimes as much as 10 times the earnings of the same period last year. So we're seeing a lot higher earnings per share. That's going to feed through to higher earnings for the entire 2025 and even higher for 2026, resulting in very low price earnings ratios in companies which will appear to be growing fast, because their earnings will be growing fast, their sales will be growing fast, and their price earnings will appear to be low, at least at today's prices. So inevitably, all the robots and the machines and the algorithms and everything else on the planet which values companies is going to say, there are some exceptions to this about how long the mines last, but they're going to say, we need to buy growth at a reasonable price. And the way you get growth at a reasonable price is by a low price earnings ratio company, which is growing fast. And that's what we're going to be looking at in a year's time.
Yeah. And at the same time, you're also seeing this oil price depreciate. We've been in an oil bear market for about 3 or so years now, since 2022. And when you look at something like the gold to oil ratio, right, in terms of gold mining companies, your numerator in this case is your output, and then your denominator is your input. And you can effectively look at this ratio in a very crude way as the margins represented of these gold and silver mining companies. And so, you're free to agree or disagree with that Clive, but I've got the ratio here in white, and you can clearly see that it tracks in this case, the silver miners index. I'm sure if you would have looked at the GDX as well, you'd see a similar tracking correlation is here too. So you definitely see this occurring with the ratio. Is that another key component? Is that the margins have been increasing due to the subdued energy costs?
Well, it's not something that I watch. I mean, I sort of the thing I would look at with gold mining companies, which obviously will have an energy component, is the all-in sustaining cost. Miners refer to it as the AISC. You'll often see that in mining reports. They say the AISC was, and then they give some number like $2,000 an ounce or $3,000 an ounce. All-in sustaining cost basically includes the cost of getting everything out of the ground, and it will include the energy cost. So that, yes, there is a relationship, but I don't specifically look at the oil price. But as you've just demonstrated, there clearly is a connection here. If we have low oil prices, it's good for the miners.
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020. Yep. So I know you've got some key pointers and tips for precious metals investors and how to evaluate these companies. So I'm going to take it over to you now. How do you want to start things off here, Clive?
Well,
what should precious metals investors be on the lookout for?
So first of all, the easy stuff. If you really don't want to do any work, you just want to take it nice and easy and spend a few minutes to find your good stocks. What you want to be looking for are, first of all, companies which are producing gold and are selling it at a profit. Now, I have been inundated in the last week by people saying, what do you think of this company? What do you think of that company? And I would say more than half of the ones I've looked at are holes in the ground with a liar sitting at the top. So what you don't want to be buying are these stocks which you have been tipped on. You've heard some friend or broker or email or WhatsApp thing or Facebook chat saying this is the greatest stock on the planet. But when I burrow down and look at it, a lot of them have not even found gold yet. They're looking for it. A lot of them have found the gold, but have no chance of digging it up in the near future. And then of course we've got the companies which dig up. But you want to get, so if you buy companies which aren't yet producing and selling at a profit, you're running a real risk that you've got a bunch of lies being told to you by someone or exaggerations. And so you're basically buying a lottery ticket. The lottery ticket is your one in a 100 chance that they're going to find that gold. They're going to then get the money, which is another problem, to dig it up, and then 5 years, 10 years from now, they'll be making a decent profit, and your share price will be up to the moon. And that can happen. It does happen, but it's a real lottery ticket. So for much safer investing, home in on the companies which are making a profit already. And it doesn't matter if you're looking at the last 12 months, or I would more particularly look at the last 3 months to make sure they're making a profit. Because a lot of companies, which are the most exciting companies, are the ones which have just started turning a profit. So if they're making a profit over the last 3 months, you can see that easily by going to the website of any company, or you can use any one of the many financial websites just to look up profits. So you could get a list of the gold mining shares or silver mining shares by looking at the fact sheet of the exchange traded funds which invest in these things, and you can find a long list. Then you could go and look at the biggest investments to start with, and you'll find on the financial websites that they're telling you, first of all, if they're making a profit. Now, the minute they're making a profit, you're in pretty good shape. But there's another question which you want to know is, will they make more profit next year? And I think all across the board, the answer is yes. But the sort of follow-on question is, will they make more profit because they're going to dig up more gold as well next year than they dug up this year? It's all very well this year selling 1 million ounces at $3,000, and next year selling 900,000 ounces at $3,500 ounces. But in a way, that company's going backwards because the volume of its sales, the amount of gold it's digging up, is going backwards. So one of the things if you want to go to the next step beyond finding companies with a profit, grab the annual report and accounts of the company, chuck it into ChatGPT. I use the plus version. That's the $29, $30, or $20 a month version. Chuck it into ChatGPT and say, read this and tell me, are they going to dig up more gold or more silver next year than last year? You don't have to read the thing. It's hundreds of pages long. Nobody can read that. Just ask ChatGPT, but you have to give ChatGPT the annual report or the quarterly report. It doesn't matter. Just chuck it in there and say, will it produce more gold? And it'll tell you the answer. And if it's going to produce more gold or silver, you're at least going in the right direction. And then you could go even further. You could say, what about 2026? And what about 2027 if you really want to? But it will probably have to guesstimate the answers, because most gold and silver mining companies don't actually tell you that information. They might tell you a target which is a bit further out, like by 2030 we want to be producing 500,000 ounces of gold. They might give you a direction of travel, but the main thing is to find gold mining companies which are making profits, and ideally find gold mining companies or silver mining companies which are going to make profits which will go up because the number of ounces go up and because the gold price and silver price has gone up. So that would be the first step. But I'm going to talk a little bit about how, if you want to go to a deeper level than just spending a few minutes on it, you could value any gold mining company and work out how much profit you're going to be making in the future if things pan out the way you expect. Now, a lot depends on what the future gold price will be, and you have to take a year in the future. For illustration purposes, when I did my maths, I took 2027 because that's not too far out, and therefore I can guess a number of things, how they'll be in 2027. So for 2027, I took a rather conservative price for the silver. I took $50, which is not far away. We're at $41, as good as makes no difference now. And I took for gold, I took $5,000. We're at $3,500 now. So that's not too far away. It's 2 years away. And I think we can get to $5,000 gold. I think we can get to $50 silver. So if you want to know what the share price of one of your companies that you're looking at might be in 2027, you could do this. And this is a little bit more complicated, but I'm going to try and make it really simple, even for those who don't really understand accounts and numbers. You find out what the all-in sustaining cost is for their gold. They might call it gold equivalent, GOE, gold equivalent ounces. That's an expression used by gold mining companies. So if they they dig up gold and silver, they convert all their silver into gold at, say, 80 to 1 to get to what's called gold equivalent ounces, and multiply everything by 80 if it's silver. But you want to find out what's called the all-in sustaining cost and take that number away from the gold price that you think will apply in 2027. So if you think that the gold price in 2027 will be $5,000 an ounce, and now you go to your first gold mining company and you find that their all-in sustaining cost is $2,500 an ounce, you now know that their profit per ounce this year is, or would be, $2,500 an ounce if the gold price was 5,000. Because they're digging it up, it cost them 2,500, and they're selling it for 5. Difference is 2,500. It would be 2,500. Of course, that all-in sustaining cost will be higher in 2025. So you have to increase it a bit. So if the all-in sustaining cost is 2,500, have a guess how much it's going to increase by 2027. And I would say maybe it's going to be 2,700. So you take away the 5,000 that they're going to sell it at. That's your guess at the future price. Take away the 2,700 and you get to a figure of $2,300 per ounce. The next question is, and this is where AI can help you out if you haven't got the time to do it yourself, is how many ounces of gold will they mine in 2027? Now, it's fairly easy to guess that number on your own by taking the current year's number and just saying it'll be the same. But if you want a more accurate number, and certainly I recommend doing this, either read the accounts and see what the company's got to say about itself, or for the specific company, ask the question, and AI will, again, take those annual accounts, burrow through, look for the chairman's statement about what their plans are, where they're going, and say, based on management guidance, we expect them to produce 550,000 ounces of gold in 2027. So you take that figure I calculated before, the gold price minus the all-in sustaining cost, that's the profit per ounce of gold, multiply it by the number of ounces of gold they're going to mine. That gives you the gross profit. But you have to knock off from that the other costs. All gold mining companies have other costs. And these could be the cost of advertising, the cost of prospecting, they could be the cost of paying taxes and things like that. Now, if you could read accounts, you can work out what those other costs are because you can see them in front of you and in front of your eyes in the accounts. It's very clear. But if you can't, just take a simple number like 30% of the gross profit and assume that 30% of the gross profit will be the other costs. That gives you the net profit of the entire company. Now you take the net profit that you just worked out and divide it by the number of shares in existence. Again, that's an easy number to find. You can find it on lots of financial websites, or you can find it in the company accounts. So you divide the net profit by the number of shares and you get to what's called an earnings per share. And the last question is, you have to guess this number. What multiple will the market apply to the earnings per share in 2027? Well, if it's very low and dull like it is today, it might be 10 times. But of course, these will all look like, as the silver price, gold price should have gone up based on your guess of $5,000 an ounce. Probably it'll look like a growth company by then, and therefore the price earnings multiple might not be 10, it might be 15 or 20 or 30. But you have to take your guess at the future price earnings multiple, and you'll then see your earnings per share times the future price earnings multiple. You'll see what the share price would be. Now compare that with today's price, and you'll see in many cases that you're going to make, even on a very conservative view, which is the one I used, easily 3-4 times your money in many cases. Well, some cases less than that, 1.5 times your money. And there'll be the one or two outliers where it might be much more than that, especially if you choose to use a higher P ratio or a higher gold price. Then you could get some really extraordinary multiples, all the way up to 50, even perhaps even 100 times if you really want to. But use a conservative number and you'll see where it comes in. And you will find that the vast majority of companies which are producing today are likely to be on a higher price and sufficiently higher to make you a good profit by 2027 if the gold price is $5,000 and silver price 50. But take another number and you'll get another result.
How do you typically choose your multiple?
I take 10 times, but I like to be conservative because I also test this with $3,500 for gold as well and $20 for gold, because you'll get a different set of multiples. And to tell the truth, there aren't that many companies which will have higher share prices if the gold price and the silver price stays where it is, and if the multiple stays where it is.
Interesting. So do you have any examples of some of these companies that you've worked out that we can look at?
Potential future price of a share. And in this case, I think you can see the company called it's a gold mining company called Altin Gold, traded in this case in London. But you could apply the same principle to a company anywhere on the planet. So in this case, I'm assuming that this particular company, which by the way is a very, very risky company because their main source of gold is in Kazakhstan. Can you see everything on the screen there?
Yep.
So bear in mind, political risk extremely high. So don't jump on this one just because I'm showing it to you. But it's just the example of how to do the calculation. So in this case, I'm assuming that they're going to dig the gold out of the ground at $5,000 an ounce. And I can see from what they have said in the last quarterly report that they expect the all-in sustaining cost to be $1,050 an ounce. And I can see also that they expect to mine 75,000 ounces of gold in 2027. And I can15 based on looking at the accounts, I've done the maths on this, that their other expenses are going to be 15,470,000, and I can see 27 million shares in existence, and I can see a price earnings ratio. So working through the maths here, gross profit I've worked out at being $296 million, and that is based on $5,000 less the cost of 1,050 multiplied by 75,000. So I'll just do that maths here just to show you. Equals, open brackets, 5,000 minus 1,050 multiplied by 75,000. So there you are. There's the figure 2,962,500, the figure I've got here.
Mm-hmm.
The next thing I do is I work out what the net profit will be. And the net profit will be the 296 take away the 15,470,000. So you can see that 296 minus 15 million will come to 283 million. Let's just check that. So that's going to be equals the 296,250 minus the other expenses that I reckon they've got, and that was taken from their accounts. Okay, I get to 280. Something may have changed there recently, but I get to 280 million. Mm-hmm. Now I divide that figure, 280 million, by the earnings per share. So by the number of shares. So I take the 280 million profit they're going to make, net profit, divided by the number of shares, which is the 27,332,000 here. And I get a profit of $10.27 per share. I multiply that by the price earnings ratio that I took, which is 10 times. So that's equal to the earnings per share times 10. And I get to a possible share price in dollars of $102 per share.
Right.
Now I've got to divide that by the sterling dollar rate, because this is a dollar profit and the shares are priced in sterling, and dividing it by the about 130 or whatever the exchange rate is, I get to a future share price of $77, and the current share price is £8.18. So the profit potential is 9 times my investment if everything happens the way it's supposed to. Now, there's always going to be hiccups, because part of the calculation for this $75,000 is 75,000 ounces is a new mine that they expected to open by the second quarter of next year. It should come on stream big time. So when that mine starts, obviously they're producing gold already. By the way, the price earnings ratio, if you look at the price earnings ratio on Yahoo or anything, you'll find the price earnings ratio is about 2 or 3 times earnings. Very, very low. And the reason it's so low is because of the political risk of Kazakhstan. You know, it's stable, and they've just passed some laws which are in favor of gold mining companies, i.e. for companies like this which are exporting gold. I think they've removed sales tax from gold, basically. But it's a country which is fragile, let's put it that way. So you never know what's going to happen by 2027. That's why there's a low price earnings ratio today. But if everything stays the same and it's still stable in that country, if this company digs up the gold that it thinks it's going to dig up out of this new mine that's coming on stream, if it makes the money I say it's going to make, if its expenses are what I say, if the price earnings ratio multiple is what I say, if the gold price is what I say, it could well be at a price of 100, well, it'd be in sterling terms, £77 compared with the price of about £8 today, huge profit. But and then as you go through these companies, if I put in a different gold price, let's say I change the gold price to, I'll just work that, I'll just divide that by 130 to get the gold price. So that's get the share price to equals, I'll take the $102, divide it by, I don't 1.30 just to get approximate. So that gives me £79 compared with today's share price, which is a multiple of, so I'm going to take equals 79 divided by 8.18, the recent share price, and I get to 9 times. But what happens if I change the gold price to, let's say, 3,500, the price today?
Mm-hmm.
You only make 5 times your money.
It's not
and
bad.
what if I? Well, it's not bad. Obviously, bear in mind they've still got to dig this mountain of gold up that they say it's their numbers. I'm not taking mine. I'm not guessing at it. I'm taking their numbers here. And what happens if I put, let's say the gold price goes to 9,000, which is entirely possible. Well, we're in a bull run like this. Well, you're going to make 19 times your money.
Fascinating. So you could effectively create like this confidence interval, or like this an interval. You may not know exactly where the price is going, but in this case, you could say worst case scenario stays where it is, gold price that is. Best case scenario, go up to 9,000, and we're looking at somewhere around a 5 to 20x for the most part.
On some companies, yes. I mean, there's many companies where I've done the maths, and you're looking in a much, much safer environment at 1.5 to 2.5 times your profit. So everything depends on how safe you want to be. If you want to find a gold miner in North America who's digging the gold up in North America, the profit potential is nowhere near as high, but it's still very high. It's still many multiples of today's price. But you've got much less political risk if you've got a gold miner in Canada digging up in Canada, or Australia digging up in Australia, or USA digging up in USA. I mean, I'd say much less in the USA. I'm kind of smiling at that because I think the political risk of the USA is rising rapidly.
Yeah. Well, this has been a very fascinating discussion here, Clive. Anything else that you think investors should be aware of before we close things out here?
Well, first of all, I'd urge investors not to rush too quickly into anything. When you get excited about something, and I can understand some people might be excited after what they just saw, go slowly. The way I think you should play the game is to buy 1/3 of what you really want to invest into a particular stock. So you should have a lot of stocks, not just one. You invest 1/3 of what you think you want to invest eventually. Then you sit on it for a few weeks and see how you feel. If you feel good, and if there's been no bad news, you can buy another third. And you'll probably feel good if the price has gone up already. So if the price has gone up already, when you buy your second third, literally you can't lose money the next day, because the average of the two is going to be higher. Is going to be higher than or the price you just paid. Let's put it away. The average of the two is going to be in profit, even if it goes down the next day. On the other hand, if it goes down after you bought your 1/3, you can be very glad you didn't put the other 2/3 in, because you've got lots of spare capital to put another third in at a lower price. But only do that if there's been no bad news. But typically, more often than not, companies which are going up because people like them, because there's good news. And companies which are going down, typically they're going down because there's something people don't like. So you're much better adding to if you buy 3 companies and 2 go up and 1 goes down, add to the 2 which went up and leave the 1 which went down for a while.
Yeah. And just a quick disclaimer, guys. None of this is to be taken as financial advice. This is just what Clive does. This is just some of the best practices that he understands, and always seek a financial professional before investing. So, Clive, thank you so much for coming on, my friend. Where can people find you if they want to see more of your work?
Well, I'd love people to go to my YouTube channel, which is Clive Thompson. Just put in Clive Thompson, and I'm all over the place. So unfortunately, it seems that a lot of spammers and scammers have grabbed my videos and put them up, and they're making lots of views. But the trouble, if you watch one which is not Clive Thompson, not my official channel, you'll find that a lot of them, those scam videos who've taken my image or taken me, they finish the video before I get to the climax. Often in the video, I'm going to tell you something really important at the end, and then you're just in the middle of the sentence and they cut it off. So make sure you're on Clive Thompson, not some other video. You'll be able to tell which one's mine by looking at it. But if it's called some other name than Clive Thompson, it's not me.
Yeah, we'll have the links to your YouTube channel. And again, I encourage you guys to check it out. Guys, if you enjoyed this podcast, drop us a like and comment "Go Clive Go" in the comment section. Let me know if you want to see more of these types of videos where we kind of can walk you through some of the best practices and investing strategies that other experts utilize. Let me know in the comments whether you agreed, disagreed. I do, in fact, read the comments. So drop me your thoughts down below and subscribe to the channel so you don't miss another episode. And by doing so, by liking, subscribing, commenting, doing all the YouTube engagement stuff that we're all supposed to tell you to do, you effectively boost this video and this channel and this message in the algorithm. So it may not seem like much, but a little bit certainly goes a long way. And then finally, if you'd like to support us more so monetarily, then consider becoming a Substack paid subscriber by joining CapitalCosm.substack.com. And in return, you'll get access to all of my stuff before the YouTube audience does. You'll get all my stuff ad-free, and you'll get the chance to recommend me guests and ask my future guests questions. And we might be adding in some more features down the line as well. So I appreciate your time, guys, and I will catch you later. Bye.
Thanks, Danny. Thanks to all your viewers.